Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Estée Lauder. So this one is very beaten down after their recent earnings, and we can see why right here, this drop in their EPS and their guidance. So I put in what they have forecasted with their guidance for the rest of the year, and kind of forecasted out some of these numbers myself based on how they've typically performed, such as the share count, free cash flows, and tried to come up with a fair value number as of these earnings. But we can look right at the 3-year CAGRs as normal. Revenue is lower than we'd like it to be. Cost of goods higher than the revenue is not something that we like to see. They have been able to cut their expenses, or at least grow their revenue faster than their expenses, and they've been able to bring more to the bottom line. With 9.49% growth in their EBIT and only 6% top line growth. Earnings per share, 10.58%, again, in line with the EBIT. They're pretty good at bringing that money to the bottom line. We see they have high margins, 75, 76%, which is very nice. Their expenses as a portion of their revenue is pretty high too, 80%, 80 to 85, which gives them a net percent in the teens. As for the second portion, we're looking at the share count. They have been buying back shares very slowly. They did see a jump. They seem to be a little all over the place here, so it doesn't look like it's really their goal. As for the shareholders' equity, that's growing great, and free cash flows are growing pretty well. We'd like to see them a little bit higher, but still, growing is better than declining. Their free cash flow yield, typically around 11%. That's what I use to calculate what their free cash flow would be for this year based on their top line. And they are slightly declining in that metric. I mean, it had hopped up to 18.5, so it's a little all over the place. Assets, they're very good at growing their assets, clearly, even their tangible assets. Liabilities, they're also very good at growing too, not something that we really like to see. It's not awful. They still have a positive tangible book value. They come to a book value per share as of the end of last year of $15.53, and that value has been growing nearly 9% year over year. Cash on hand, they have almost $11 in cash per share. They're growing that about 10% year over year. Dividend, they're doing great at growing that dividend. They're paying out $2.64 on an annual basis, and that gives us a yield that is relatively low for such a high share price. The stock is currently trading at 182. As we see historically, at the end of last year, it was almost 250. The year before that, it was 354. So it has been on a huge decline since 2021. So the question is this the time to jump into it? I don't really think so. I'd give it a hold. I want to see how things play out. As of the last year, the fair value would have been $207, which would make this 182 not too bad. We'd like to see it more towards the 160 range before getting in as a value play. But with these earnings, their guidance, it drops it down to 141, which would give us a fair value right around $112 to be buying in for a value play. ROE, very healthy. What we're looking for, I mean, higher would be better, as always, but that's good. Abnormally high PE, like very high PE historically. I mean, 1 year was 137. They're not showing a whole lot of growth for that kind of PE. The market seems to give them a very large premium and stays with that premium. Like personally, I broke it down to what I would like to see in this company and not what the market would like to see. So we'd be looking for a PE of 20 to 25, cash flows of at least a 3% yield. Balance sheet, I believe I just went off of what they already had. And then the dividend, I'd like to see something at a 2.5% yield. And through all those metrics, I'm coming up with a value of $156 is like the perfect value that I would like to pay for the company. So that is what we're looking at with the numbers. I've already worked in some of the earnings numbers, so we don't have to dive too deep into that earnings report because of that, but we can move on to the chart and see what is going on there. So looking at this chart, we see the just massive decline. It peaked back in 2021 in the November to January 2022 timeframe at $370 a share. And it is down almost $200 from that point, closing today just shy of $185. So I have the fair values mapped out here. That old fair value of 207 would have put the stock here, where it's been trading above that for quite some time, ever since 2020. And then the new fair value, based off these new earnings, puts it down here, right about that $140 level. And we haven't seen this price since the COVID bottom. So we'll see if it drops back down to this. I mean, there's really not a whole lot of support or resistance in this range. So if the market is shunning the company, it might drop down to $140. And I mean, even at 160, I'd start picking away at it, picking up some shares, because this year could just be a blip. And if it is, and they get back on track, this stock could double from here. And with such a large price per share, that'd be some pretty crazy earnings. The buy zone would be around that 110 level. Really not touch that. It hasn't touched that since 2017. I had to zoom very far out for us to even see the values that we're looking at, because in the last 2 years, it's been trading kind of sideways, mostly down. But that's what the chart has to tell for us. I mean, we can add a few lines in here and say, here's the bottom. We get at least one solid touch point here. Even better yet, it looks like we get two pretty solid touch points here, but we've broken down below that. And we've broken down below that. And then we could do even another trend here. Looks like we get about 3 touch points there. So it may, just based off the technicals, it may go down to that around 150 level. That's where our trend lines intersect. That's where we see some support at. So it could be heading back down to its fair value. This would be one to watch. I don't really know about trading it, because if we're wrong, it turns around, that shorting this could really hurt. So we'll move on to the earnings and see exactly why this saw such a dramatic drop. And here we go. They're in their third quarter. I highlighted some stuff. It is all down below. And the main thing here is that the CEO said that they anticipated this quarter to be challenging, and they're glad that they were at least able to deliver on the higher end of their outlook for that quarter. So if we continue down, we see that they acquired the Tom Ford brand, which I'll have to look deeper into. That may help them bolster their performance a little bit. And they lowered their EPS and sales for the year, and we'll get into that later on. Just looking at a few of the numbers, skincare, we see a 20% decline, makeup 2%. It's kind of declines all over the board. Fragrance and hair up 1%. Nothing impressive in the growth, but quite a bit in decline. And then we can come and look at geographic region. Huge decline in Europe and Africa, moderate decline in Asia. From what I was reading through, they were blaming a lot of the declines on Asia and the lockdowns and travel restrictions. So based on what I'm seeing, I don't really see that. I think that's a region that they're expanding into, and they were expecting more growth. So even any decline there is kind of drastic for them. Here we get their full year guidance. So they forecast a decrease between 12 and 10% on their top line sales. I put 11 into our calculations. They're expecting earnings somewhere between $329 and $339, which is about in line with what analysts are expecting. And that's what we saw in our calculations as well. But if we continue down, we can get to the numbers we're looking for. Net sales were down 12%. Cost of goods was up 17%. So between those two, that is not a good sign. The gross profit was down 20% with a gross margin of 69%. That's down from their historically 75, as we see last year, same quarter. They had done 76.5. Net earnings, we see a 73% decline. Now, we do have that acquisition in all of this. So that is something that they're investing in and is going to help them in the long run, not just some giant cash suck, hopefully. Basic earnings per share, we see 44 cents compared to the 155 last year for a 72% decline. Their shares outstanding, we see a decline there. So they are buying back their shares at least a little bit. Here's the trend over the last 9 months. And we see 20% decline in skincare again, 7 in makeup, 1 in fragrance, and 3 in other, with hair care coming in up 3%. So declines across the board over almost the entirety of the last year. Now, this is a trend that I'd want to see in 1 or 2 earnings reports if they're able to reverse the declines. I'd want a bit of a margin of safety. So I'd say maybe rather than waiting for it to drop to this 140, maybe something closer to 130, if at all possible, to pick up the bulk of a position. But if we continue on with those earnings, liabilities are up, or the current liabilities are up, but the non-current liabilities are down a little bit. Total equity is up. And that's about all that they give us. We see some cash flows here. Cash flow from operations was down. They spent about the same on most things. Looks like their payment to acquire treasury stock was significantly less than last year. And their proceeds of current debt was more. But that's all we have to look at here. We could read through all of this if we want, but this is just supposed to be a top line overview. If I were giving it a buy rating, then I'd read through this very closely, but something to hold on to, take a look back at down the road when we're able to give this a buy rating and just confirm our buy and build a thesis. So I give it a hold. Like I said, I'm going to be waiting for it to drop. It'd be nice to get it around $140. Cheaper than that would be better with the declines that we see. Like if we're able to go back to this support point here, just shy of 130, that'd be the perfect zone for me to buy in. But we'll see if that happens. I want to thank you guys for watching. Let me know if there's any other stocks you want to look at. If you agree with this analysis, you want me to take a different look at it. Like if this was helpful, and let me know if you guys want me to continue following Estee Lauder or not. Subscribe if you do, and I will catch you guys next time.